The housing crash we've all been waiting for is finally happening. Home prices are dropping in key markets across the country, with the National Association of Realtors reporting March had the slowest home sales in over a decade since 2009. But why now, after years of skyrocketing prices that seemed unstoppable? What finally broke the market? In this video, I'll break down exactly why housing prices are falling and what it means for you if you've been waiting on the sidelines to buy. Have you been wondering when the housing market would hit its limit? Well, that moment is now, because after years of watching home prices climb to levels that seemed impossible, we're finally seeing the first real signs of a market correction. For nearly a decade, housing prices have climbed relentlessly upward, pushing the dream of home ownership further away from millions of Americans, and what started as a recovery from the 2008 crash turned into a runaway train that left average wage earners completely behind, and the pandemic only accelerated this trend, with remote work and low interest rates driving a buying frenzy and inventory shortage that sent prices soaring even higher. Because today, home prices sit at about an average of 7.2 times the average American income, creating the worst affordability crisis in modern history. And to put this in perspective, historically, homes have cost around 3 to 4 times the average income, but we're now at nearly double that rate, which explains why so many people feel priced out of the market entirely. And the real world impact is staggering, especially for first-time buyers. Someone looking at the exact same house today compared to 3 years ago is facing monthly payments that are roughly 50% higher. And this isn't just a minor inconvenience, it's completely reshaping who can and can't afford to buy a home in America. You see, the math simply doesn't work anymore for most Americans. And let me show you what I mean. A home that cost $400,000 in 2021 with a 3% interest rate would have a payment of roughly $1,686, not including taxes and insurance, but that same $400,000 home today at 7% interest rates has a payment of $2,661, which is a $975 increase per month, or $12,000 per year, just to own the exact same house. And to make matters worse, these higher housing prices mean that property taxes and insurance are now more expensive as well, making these same already expensive payments even more expensive. And that massive jump in monthly cost means that buyers can afford much less house with the same income. Someone who qualified for a $500,000 home 3 years ago might only qualify for a $350,000 home today. But the problem is, there aren't very many $350,000 homes left in most major markets. And right now, we're seeing the sharpest price reversals in exactly the markets you'd expect. Those that saw 30% plus price increases during the pandemic. This is for cities like Phoenix, Austin, Boise, and Las Vegas that were pandemic boomtowns, and they are now leading the way in price reductions. These markets got the most overheated and are now cooling the fastest. And the inventory signals are equally telling as well. You see, homes are sitting on the market 2 to 3 times longer than they were last year in many key markets. And according to the NAR data, homes stayed on the market for an average of 41 days in January, up from 35 days in December and up from 36 days the previous January. And this extended market time is a clear indicator that buyer demand has cooled significantly, and perhaps most importantly, we're seeing a psychological shift in the market. After years of accepting whatever price sellers demanded, buyers have finally started saying no to unreasonable prices, and this has created a standoff between buyers and sellers, with sellers still expecting 2022 prices, while buyers can only afford 2020 payments. As Lawrence Yoon, NAR's chief economist, explained, home buying and selling remained sluggish in March due to the affordability challenges associated with high mortgage rates. And this sluggishness isn't just a temporary blip, it's the market finally responding to the reality that prices have simply gone too high. You see, the truth is housing prices are finally dropping because the market has reached true unaffordability. The math simply doesn't work for buyers anymore, which is why investors have dropped out of the market as well. When monthly payments get so high that qualified buyers disappear, sellers have only 2 choices. 1 is wait, 2 is lower their price, and increasingly, they're choosing to lower prices. But this is just the first crack in the foundation of the housing market, and to understand how deep this correction might go, we need to look at what the experts are saying about this shift and the data they're using to make market predictions. What happens when a market suddenly sees its slowest month in over a decade? Well, the answer tells us everything about where housing prices are headed, and it's not good news for sellers. The National Association of Realtors just released their March sales report, and the numbers shocked even seasoned market watchers. This isn't just another monthly update, it's the clearest signal yet that the housing market has reached a genuine turning point. You see, March 2025 home sales hit their lowest level in over 10 years, with sales plummeting to a seasonally adjusted annual rate of 4.02 million units, which is a 5.9% drop from February and represents the slowest March sales pace since 2009, when we were in the depths of the subprime mortgage crisis. And even more telling is that existing home sales have fallen 22% compared to the previous year. And the truth is, this isn't just a minor slowdown or temporary blip. These numbers represent a fundamental shift in market dynamics that's been building for months. You see, when sales volume drops this dramatically, price cuts almost always follow. It's simple supply and demand. You see, fewer buyers means less competition, and less competition means falling prices. And if we look at the regional breakdown, this shows us which parts of the country are feeling the most pain. The West experienced the most significant monthly decline, with sales dropping over 9%, and the South wasn't far behind with a 5.7% decrease, while the Midwest saw a 5% drop and the Northeast declined by 2%. And this does vary by market, so it's going to vary for each specific market, but the price data from the NAR report tells an equally concerning story, because while the median price of an existing home sold in March was $403,000, technically an all-time high for the month, it only represented a 2.7% increase from the previous March, and this shrinking annual comparison is the smallest gain since August, indicating that price growth is rapidly decelerating. And even more telling is what's happening with inventory. You see, the total supply of existing homes for sale at the end of March was 1.33 million units, up 8.1% from February and a whopping 19.8% from a year ago. And this represents a 4-month supply of homes at the current sales pace. More inventory means that more buyers have more options and more negotiating power, putting further downward pressure on prices. And NAR chief economist Lawrence Yun had very strong words about what's causing the slowdown. He attributed the sluggish sales in March to affordability challenges associated with high mortgage rates, and Yun went even further, warning that residential housing mobility, currently at historic lows, signals the troublesome possibility of less economic mobility for society. And what makes these numbers even more concerning is that they precede President Trump's April 2nd tariff announcement, which introduced even more economic uncertainty for homebuyers, because this means that April numbers could show an even steeper decline in home sales. And when we compare these figures to previous housing corrections, a familiar pattern emerges. Sales volume typically falls first, followed by prices. The current sales decline mirrors what we saw in late 2006 and early 2007, right before prices began their multi-year slide. While today's housing market has different fundamentals, the pattern of declining sales leading to price drops remains consistent. The NAR report confirms that we're seeing a genuine market correction, not just a temporary blip on the radar. Sales volume is often the first indicator before prices follow, and the current volume drop is severe by any measure. And when you combine falling sales with rising inventory and the smallest price growth we've seen in months, all signs point to a market that's finally tipping in a buyer's favor. But there's another force at work that's making this correction even more powerful. The slowdown in sales isn't happening in isolation. It's part of a perfect storm that includes interest rates, inventory, as well as broader economic pressures all converging at once. And we'll talk about these forces shortly, but if you're enjoying this content so far, please hit the like button for the algorithm and consider subscribing to the channel to stay up to date on the latest macroeconomic trends if you found this content helpful. So what happens when 3 major market forces all shift at once? A perfect storm that's finally bringing housing prices back to reality. You see, for years, the housing market has been protected by 3 key factors: low interest rates, limited inventory, and a strong economy. These pillars created a foundation for ever-increasing home prices that seemed unshakable. No matter what happened in the broader economy, housing just kept climbing. The truth is that those days are over, and all 3 pillars are crumbling simultaneously, creating unprecedented pressure on home prices. This isn't just a minor adjustment, it's a fundamental shift in market dynamics that explains why we're seeing price drops across the country. Let's look at interest rates first. The Fed's fight against inflation has pushed mortgage rates to levels we haven't seen in decades. While short-term rates have started to come down, mortgage rates remain stubbornly high, hovering over 6.5% to 7% for extended periods of time. And this, in conjunction with higher home prices, has more than doubled the monthly payment on the exact same house compared to 2021. As NAR chief economist Lawrence Yun put it, home buying and selling remained sluggish in March due to the affordability challenges associated with high mortgage rates. And those high rates reflect policy uncertainty and concerns about future economic growth. And what this has done is also trapped millions of homeowners in their current properties with low-rate mortgages that they can't afford to give up. And at the same time, inventory is finally starting to build. The total supply of existing homes for sale at the end of March was 1.33 million units, up nearly 20% from March of 2024. And this represents a 4-month supply at the current sales pace, still below the 6-month supply considered a balanced market, but a significant improvement from the extreme shortage we saw during the pandemic. And new construction is also hitting the market just as fewer people can qualify to buy homes, creating a supply-demand imbalance that favors buyers for the first time in years. You see, while inventory remains below pre-pandemic levels, the trend is clear that more homes are available and fewer people can afford to buy them, which is driving prices down. And the economic warning signs are equally concerning. Rising anxiety amongst consumers over inflation and job security is affecting buyer confidence. And as Robert Frick, a corporate economist with Navy Federal Credit Union, noted, these concerns are starting to magnify the instinct to hunker down and is already being felt by many families. This economic uncertainty extends beyond just housing. The April 2nd tariff announcement introduced even more questions about the direction of the economy. And this came after the March housing data was already showing trouble. These tariffs increased construction costs while simultaneously cooling the broader economy, which is a double whammy for housing. And we're also seeing investors pull back from the market after years of aggressive buying. Cash buyers represented 29% of sales in January, down from 32% a year earlier, while investors still account for about 15% of sales, according to recent data. And their dominance is waning as rising prices and higher rates eat into potential profits and rate of return on these properties. And the combination of these factors explains why housing prices are finally falling. We're experiencing a perfect storm of high rates, growing inventory, and economic uncertainty, all hitting at once, and this convergence of factors is why the correction is happening now, after years of experts wrongly predicting a crash that hasn't yet materialized. And the resilience of the housing market over the past decade led many to believe prices would never come down significantly, but what we're seeing now isn't just a typical market adjustment, it's the result of multiple pressures all pushing in the same direction. When buyers can't afford homes due to high rates, when more homes are available for sale, and when economic uncertainty makes large purchases risky, prices have nowhere to go but down. The market is finally responding to these realities, which is creating the perfect conditions for a significant correction in home values. And this convergence of factors explains why the housing market is finally correcting after years of defying gravity. The question isn't if prices will continue falling, but how much further they'll drop before reaching a new equilibrium. The housing market correction isn't just happening, it's accelerating, and what we're seeing now creates both risks and opportunities depending on your situation. All the data points to a significant shift that's only going to intensify in the coming months. But the good news is if you've been waiting for prices to fall, your patience is finally being rewarded, because the perfect storm of high interest rates, growing inventory, and economic pressure is all pushing prices downward in markets across the country, which means the real question isn't if prices will continue falling, but how much further they'll drop before reaching a new equilibrium. And the next 12 to 24 months will be crucial for anyone looking to buy, which means if you're an active buyer in the market, the key takeaway is that we're in a solid buyer's market with declining prices, so putting in a lower offer than you might normally consider can help you insulate yourself from further price corrections. And make sure you're subscribed to stay up to date on the housing market as things develop, and we will catch you on the next episode.